Alright guys, so in this video we're going to be going over the ICT universal models. I kind of want to make this a video series, so in this video we're just going to be going over the basics of the universal models. Simply trading around these universal models really changed my trading, and I think it could really help you too. So universal models exist to give us a framework and a draw on liquidity. It gives us a point A from which the model originates, and it gives us another point B, which is the draw on liquidity, right? And this is really all trading really is. It's just having a target and understanding how price will get to that target. Alright, so the first liquidity type I'll be teaching you guys is the internal range liquidity. We only have two main liquidity types. It's really all you need, right? It's internal range liquidity and external range liquidity. Now the internal range liquidity could be a fair gap, it could be a new day opening gap, new week opening gap. Fair gap is what you're seeing right here in this example. This is an example of a bearish fair value gap, just the opposite, right? And this is what a new day opening gap or a new week opening gap looks like. A great tip about fair value gaps is that you do not want price to completely fill them. You want them to stay open, and ideally you don't even want price to trade beyond the 50% of this gap, right? Because it heightens the probability of a trade. It can still work, but that's how you get your probability. Now I'll be teaching you the external range liquidity is just a swing high or a swing low. That's what we use as our external range liquidity, right? Very simple. This is what a swing high looks like, and this is what a swing low looks like. Now I'll be going over our actual universal models. This is what the first sequence is. It's the internal range liquidity to the external range liquidity, right? When price trades into this internal range liquidity, which is a bearish fair value gap in this example, right? We then anticipate price to reach into the external range liquidity, and this is what it looks like. This is our second universal sequence. It is the external range liquidity to the internal range liquidity. When price is trading in between a external range liquidity and an internal range liquidity, we simply wait. Once price reaches into the external range liquidity, we anticipate it to then reach into the internal range liquidity, and this is what that looks like. Now this is a great tip about universal models in general, right? When price trades into point A and fails to reverse, which is seen by the lower time frame, then we anticipate price to reverse off the high of the candle that took out the point A. Now in this example, you can see that the next day opens up, it takes out the high of the previous day, and then we reverse off that, okay? Why is this? Because the previous day expanded a lot and the wick size is large to the upside. And generally we don't expect price to expand and reverse on the same day. Now this is a bit harder to anticipate, right? You need to align the time frames and the universal models within the time frames. So this is why I gotta make a second video on this. What you need to take away from this is that if price fails to reverse from a key level, then we can anticipate it to reverse off the high of the candle that took out the key level in this example. And for the bullish example, if price fails to reverse from the bullish key level, we would anticipate price to reverse of the low of the candle that took out the key level. And now this is our third universal models. It is simply when price forms a range and then it takes out one side of the range to trade to the other side of the range. So we always want to be trading in sync with a higher time frame universal model, right? So in a bullish expansion, we would want the range low to get manipulated first so that price can reach into the range high, and then that would create the expansion. Now this is the most ideal scenario, obviously. Price will not always manipulate the range low before taking out the range high. It doesn't need to do that. It could be something like where one correlated asset would trade to the point A and one would not, right? That would create the correct correlation, making the trade even higher probability. In fact, that's how we want our universal models to form. Alright, so that's all I have for you guys in this video. Now if you guys really want to take something away from this video, I would like for you to go into your charts and look back and look for these universal models. I would recommend you to focus on the IRL to ERL and the manipulation ranges, which is the third universal model first, since those are the easiest to spot.